Welcome back, accounting students. Remember, before the ad break, we were focusing on partnership, unique ledger accounts or ledger transactions. We're now going to move on to our next question, where we're going to look at ledger accounts and we're going to analyze these ledger accounts that have been given to us. So once again, please make sure that you are working with me so that you are learning, not just watching, but you physically doing the exercise with me. So let's move on to the question. Right, so for this question, we are given ledger accounts and we are told to, just want to grab a pen, to study the following ledger accounts of CC traders and answer the following questions. So let's go straight to the ledger accounts. So they've given us the capital account for partner Craig. They've also given us the capital account for partner Candace. Right, so that's fine. If I look at the ledger accounts, I'm given an opening balance that is brought down, 500,000 for Craig. Then I notice he increased his capital on the 1st of June by 400,000, so that's in order. Then I've got capital partner Candace. So she started off with an opening balance of 400,000 and partner Candace decreased her capital by 100,000. So that's what I'm given thus far. Let's see what else they're giving me. Right, required, record the following additional adjustments for the month of August. So we've got Candace further decreased her capital by 100,000. And then we've got Craig gave his personal bucky for the business to use, and the value or the cost of that bucky an amount of 120,000. So clearly from the two adjustments we can see that Candace is decreasing her capital contribution, whereas Craig, on the other hand, remember, by him giving his personal asset to the business, obviously he is increasing his capital contribution. Okay, so let's record this first in the ledger accounts and let's see then what other questions we are faced with. So we're going to start off with Candace, decreased her capital by 100,000. In brackets, I'm just going to mention that it was cash, so that's how she decreased her capital. Right, so let's go to Candace. She's decreased her capital by 100,000. Right, so once again, the other account affected would be bank. Not too worried about the actual date, but we'll just fill in. This is obviously for the month of August. Right, then we've got partner Craig, who has increased his capital by giving his personal bucky to the business, and the value of that bucky is 120,000. So let's go to his account. Right, so he is increasing his capital by 120,000. And please remember, guys, it's not going to be bank, but obviously the other account affected would be vehicles. So this would also be recorded as vehicles 120,000. Remember, vehicles will be debited with the 120,000, and obviously this is happening in the month of August. Okay. Right, that was pretty much straightforward, recording the additional transactions, but let's move on now to some analysis and interpretation. Candace believes that the year-end profit should be shared equally. Craig disagrees. Briefly explain by providing a calculation to support Craig. Okay. So we've obviously got some kind of disagreement taking place between Candace and Craig. We've got Candace who believes, I feel the net profit that is calculated at the end of the year. Remember, we don't have much details. We don't even know when end of the year is, but she believes that that net profit must be shared equally between Candace and Craig, herself and Craig. Craig, on the other hand, says, hang on, no, that's not happening. We need to now explain, and the question tells us we supporting Craig. So we're not on Candace's side, we are supporting Craig. So let's now go back to their capital contribution, because remember, that's the only ledger account they've given us. They haven't given us anything further. So our answer, or our explanation rather, has to come from that capital account, from the information given. Very, very important. So let's go back to our ledger accounts and let's analyze each partner's capital contribution. So let's start off with Craig first. So Craig, balance of 500,000. He increased his capital by 400,000, so he's obviously sitting at 900,000. Then he brought in his own bakkie, 120,000. So obviously his capital contribution at this point in time should be sitting at, I don't think I need a calculator here. Let's just quickly do this. Right, so his contribution should be sitting at 1,020,000. So that's where Craig is sitting at, 1,020,000. Now Candace, on the other hand, she started off with 400,000. She's obviously decreased her capital by 100,000. She then further decreased it by 100,000. So her balance at the moment is sitting on 200,000. So if I had to balance her account, obviously that is her capital contribution. Now, if we look at this, guys, if we look at the capital contributed, Craig is contributing more than $1 million. Okay, so Craig's contribution is obviously 1,020,000. That's what his capital contribution is. Whereas Candace, on the other hand, her capital is sitting at 200,000. And remember, Candace is saying, give me the same net profit as Craig. Now, based on this information, can you see why we agree with Craig? Remember, we've only got capital. Obviously, other factors play into account, such as knowledge, skills, who's running the business on a daily basis, and so on. Candace could be doing more work, but remember, we can't make that assumption. We don't know. This is what we have been given. So based on this, the question now wants us to provide some kind of calculation. So you've got an option. As an accounting student, I would recommend calculate the percentage of capital contributed by Craig. Okay, so let's look at the percentage of capital contributed by him. So your total capital contributed by Candace and Craig, so the total is obviously 1,220,000. All I've done is taken Craig's capital and added on Candace's capital. If we're going to calculate Craig's percentage, all we're doing is we are taking 1,020,000 and we are dividing this by the total capital contributed. So let's grab our calculator and let's do that calculation quickly. Okay, so we've got Craig with 1,020,000. Okay, there we go. We're going to divide this by our total capital contributed by both partners, so 1,220,000, right? Remember, I'm trying to get a percentage. Okay, and let's just multiply that by 100, so we can clearly see Craig's contribution is sitting at 83.6. We can just round that to 84%. So this guy is contributing 84% of capital invested in the business. So clearly we can see why he doesn't agree with Candace, because hang on, Candace, you only contributing 16%. Okay, is that right? Should be right. You contributing 16%, I'm contributing 84%. Hello, I should get a bigger chunk of the pie. Okay, hopefully that made sense, guys. remember, analysis, look at the information given. Okay. Right, so I think that should be it in terms of the question. I just want to quickly check. Yeah, there we go. So that was the analysis question. So I'm just going to quickly summarize that for you. So remember, calculate the percentage capital that was contributed by Craig. That's what we did. Right, and remember, Craig contributed 84% of the capital. So you've answered the question by giving them that calculation that they are requiring. And remember, Candice, on the other hand, she's contributed 16%, and based on your calculation, on your findings, obviously, you are supporting Craig. Craig will deserve a greater chunk of that net profit. And as I mentioned earlier on, if you were given additional information, so for example, Candice, she works 5 times during the week, whereas Craig, on the other hand, only comes in on a Monday morning, then it could be a different scenario. And this is why that partnership agreement is so important, because the partners sit together and they discuss every aspect of the business. What capital are you bringing in? What would you be responsible for? Who's going to work on weekends and so on? Okay, so it's not that easy forming a partnership, because remember, people, there's always conflict. Where there are people, there's always conflict. And remember, you cannot make all the decisions. If it was a sole trader, obviously you can. But in a partnership, you've got to consult with the partner. Okay, right, I think we're done. Let's move on. So to summarize, accounting students, remember, make sure you constantly use the accounting equation, because remember, the accounting equation will give you that sense of whether or not you understand the unique transactions. As I mentioned before, practice, 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 your common adjustments, your calculations, and analysis and interpretation of information is key. Absolutely critical. Remember, don't just scan through your information that is given, read through your information carefully, because you've got to understand that information. Okay. Right, and then going back to our map of concepts, remember, we're busy looking at partnerships. Obviously, in today's lesson, we focused a lot on unique adjustments affecting the accounting equation, or rather, I use the accounting equation to explain your ledgers, your unique transactions. Right, we looked at ledgers, we looked at owner's equity, specifically capital, as well as drawings. Right, we've come to the end of our lesson. It's been an absolute pleasure, accounting students, assisting you, and I'm looking forward to meeting you once again and making some kind of impact in terms of your accounting knowledge. From me, Mahesh Lal, enjoy the rest of your day, and God bless, stay safe, we will chat soon.